In this video, I'm going to explain what the value-add real estate investing strategy is all about, walk you through a real-life example from a 278 unit deal we just closed on 2 weeks ago, and also show you the impact, the significant impact the value-add strategy can have on your returns and your property's valuation. So to get started, we have to talk about the two types of investors out there in the market. Well, first of all, we have a retail investor, and then we have professional investors. Now, we will define a retail investor as most of the investors out there who dabble in real estate, when they hear on the news that the market's doing really well, they think it's a great time to hop in, and they're really banking on market appreciation. A professional real estate investor, people like us, we know that we can't control the market. Nobody has a crystal ball. And if you do have a crystal ball and it's working, I'll pay you $1 million for it. So just get in touch with me and we'll do a deal. But a professional knows that we can't control the market, so we have to focus on what we can control because we can't bank on outside forces pushing our deal along, especially when we're raising a significant amount of capital. We have to be very confident that we can perform on our pro forma and our investors' expectations. So a professional focuses on what we can control, and this is the essence of the value-add real estate investing strategy. Not saying that the market isn't important. The market is very important, and you want to make sure you're investing in the right type of market. And if you want to know the top 7 key market drivers I look at when looking at a real estate market, go to topmarketdrivers.com and you can download a free report where I will walk you through the 7 market drivers we look at. So now that we know the difference between a retail investor and a professional investor, and we know that we want to be on the professional side of things, well, what sort of deals or what sort of opportunities are we looking at when we're looking at executing on a value-add strategy? Well, first of all, we have renovation. And we see this, I focus on multifamily real estate, so large commercial deals, but you see this on TV all the time with flipping shows. You buy a property, it's got an old dated kitchen, it needs some work, you do the work to it, and you sell it at a profit. Well, think of flipping, but on a much larger scale and a much longer timeline with, let's say, a 200 unit property. It's the same sort of idea. So if the kitchen needs work, if the floorings need to be replaced, if some walls need to get knocked down to modernize the space, open it up, that's the type of renovations that we're looking at. Also, we have operations, so ops. Not everybody is a great manager of a property. Some owners, their property gets put down to the bottom of the pile. They don't really stay on top of things. Expenses get out of control. They don't keep up with their rental increases. They don't look after the units if there's deferred maintenance. So we have roof issues, all sorts of, or roof, depending on which side of the country you're on. We have all sorts of issues that creep in if the management isn't on top of things. So if you can come in, clean things up, bring in a new management team that will perform, this can be definitely a very good value-add proposition. Also, we have expenses. I touched on that a little bit. So sometimes a value-add strategy, if ops are good, if the renovation, if the property's up to a good standard based on where the market is, if expenses are out of whack, let's say the insurance premium is ridiculously high, maybe that current owner didn't know the options out there. That could be something. Utilities, billing back to the tenants. So whether it's sub-metering or instituting a RUB program or anything like that, cutting down your expenses is certainly a great way to boost up your NOI. And at the end of the day, as we know, these commercial properties are valued based on the net operating income. So anytime that we can decrease expenses, which will then increase our NOI, that's always a good thing. And we'll go through a real life example later on. And also the last but not least, and probably my most favorite part, is rents, increasing rents. Are the rents under market value? And this happens all the time. And this is going to happen in the example I'll show you from the 278 unit deal. If rents are under market value, you just have to come in and boost the rents up. And then you're sitting pretty without having to do any renovations. So these would be the top 4 value add components that I would be looking for in a deal. Renovation opportunity. Operations, poor management, can you come in and clean things up? Are expenses out of whack? Typically on these larger deals, you're looking around 40 to 50% depending on the vintage of the deal in terms of expenses, and then rents, or rents under market value. Is there room to bring them up? And at the end of the day, like I said, it's all about the NOI. Anything we can do to boost up that net operating income, so increase top line revenue, so increase rents, bring in more income from the property, decrease expenses. It's always a happy day when the appraiser comes around and values your property a lot higher. And if you have any questions about this type of stuff, you can head on over to callseth.com, set up a 20-minute phone call with me, and we'll make sure all your real estate investing questions are answered. So let's hop over to the example I'm going to show you. 278 units in Orlando. Great property. It's sitting right on a lake, so it's really like a resort. It's a fantastic property. I'm very excited to implement everything that we are talking about right today. So let's talk about what we saw in this property. Well, first of all, there's a renovation opportunity. So this property, the previous owner had actually renovated it 4 years ago, but the kitchens still look pretty dated. They were that mahogany color. Well, lots of the units had that mahogany color. And right now, white kitchens are really in style. So we're coming in, we're changing up the cabinet doors, changing those over to white, adding a backsplash, putting in new flooring, a faux wood flooring. That's going to modernize everything. The tenants are going to be a whole lot happier. It's going to look fantastic once it's all done. And plus, once that renovation work gets done, well, the rents can go up. And that's always a good day too. Now, conservatively speaking, so keeping things very conservative because you never want to overpromise and underdeliver, there is room for a $50 to $75 increase a month on units. So a 1-bedroom unit is at your $50 increase, and then your 2-bedroom plus is at your $75. Now, this is where things get really exciting. This is on the conservative side. There are comparables right now. So our competitors in the marketplace that have a similar product of our post-renovation product at $150 higher than what the rents are at right now. So that's a $150 difference that potentially we can bring our rents up to, and factor that over 278 units. That's a very large impact on our bottom line, and I'll show you that in the next section, and we'll walk through exactly how you calculate this type of thing. Also, I talked about driving that top line revenue, getting in additional income streams from the property. And this is where this property has some really great opportunities in terms of driving more income. So first of all, we have a valet trash service. So this is where somebody doesn't want to take their trash all the way out to the dumpster. They can just leave it outside their door and we will pick it up for them every month for a fee. So that's one thing we're implementing. We also have storage opportunities on the property. We also have private lawn. So not everybody is able to have a backyard, but let's say you have a pet or some young kids and you want to make sure you have that private space. For an additional fee per month, we can make sure that you have your own private backyard. That's going to drive revenue to us. And then we have premium parking, so covered parking, that's also an additional charge. All these things besides the renovation to bring up our standard, in turn increasing the amount of rent we can charge, bumping up the rents. Like I said, conservatively we're looking at $50 to $75 a unit, but realistically our competitors are about $150 higher. That's definitely a big opportunity. And then we're bringing in all sorts of other things. We've already boosted up the occupancy. That was a lucky break. On closing, occupancy actually went up, so we have about $150,000 more per year now than when we underwrote the deal and originally looked at it. So lots of great things happening with this. And if you have questions, or if you want to know how you can invest in these types of deals, because we raise money from investors, just head on over to callseth.com and we can have a quick chat over Zoom. It's via video, so we can chat face to face thanks to the power of the internet. So the impact of increasing rents, implementing a value add strategy on the valuation of your building. Well, we all know, and I alluded to this before, that with commercial properties, that these properties are valued based on the income approach. So it's not looking at apples to apples like we do with a single family home. It's all based on the NOI. So all we do, this is the formula. It's really simple. So we take the NOI, we divide it by the market cap rate. And if you don't know what a cap rate is, I have some other videos on a cap rate, or you can just head on over to callseth.com and we'll get you all straightened out. And that's going to give you your valuation. So let's say we have 100 units that we're renovating, and we can increase those after renovation, let's say $100 a month. So that's going to give us $120,000 a year in additional revenue. And our expenses don't increase. Let's say we raise the capital, so we're not, I won't complicate things by factoring debt for this example. So we increased $120,000 and our cap rate, so let's use a cap rate of 4.5%. And I should have figured this out with the calculator before I started the video, but 124.5, it's going to be 2,666,000, I think. Yeah, I think that's right. If you're at home with the calculator, put it in the comment section the exact answer, but I think it's going to be 2,666,000, something around there. Over a $2.5 million increase for recognizing an opportunity to bump up the rents when we have competitors in a surrounding area. They're all charging X amount. The current owner didn't increase rents, let's say, and we saw this opportunity. That's an additional $2.5 million in terms of valuation for your property. Now, this is where things get exciting. So let's say you recognize all these opportunities, and we'll use the 278 unit example because that's fresh in my mind and I'm really excited about it. Let's say once we implement all those value add strategies, so we do the renovations, we increase the rents, we have the valley trash service, the private backyards, all those things bumping up our NOI. What we can do 2 years later, we've forced the appreciation. We've controlled the valuation of the property by not waiting for the market to appreciate. We've taken control, taken charge, and done things that we can control to impact the returns our investors make. One of the most exciting things with the value add strategy is called a refinance. So I'll just say refi. When we do a refinance, we're basically remortgaging the property. So when we bought the property, we had X amount of debt, but now that we've increased the value of the property through increasing the NOI, implementing our value add strategy, we're now able to put more debt on the property because the value of the property has gone up, and an appraiser will value it higher, which means the bank wants to lend us more money. So that means that once we've implemented our value add strategy, we can do a refi, pull cash out, and that's more money in our pocket and the investors' pockets, and then the deal's still going to keep running for the length of our hold period. So whether it's 5 years, 6 years, 7 years, you name it, the deal's going to keep running, and that's going to bump up our returns because we have less capital in the deal. We have more of other people's money, namely the bank, in the deal for us. So this is the beautiful thing about value add real estate investing. So if you have questions about the value add real estate investing strategy or the deals we're doing right now and how you can get involved, just head on over to callseth.com and we'll set up a quick 20-minute chat. Thanks a lot. Talk to you guys soon.